The market has opened and it's green pretty much right across the board. We do see Tesla down around 7.5%, something that we just covered earlier today. Now there are some worrying aspects of the S&P. When we take a look at it from a central P ratio, we can see it is now trading around 30.2, and in comparison to the previous historical numbers, it does look to be on the higher end. Now the focus in today's episode, we're doing a very quick analysis of 10 undervalued dividend stocks near their 52-week lows. Jumping into the first one, we have Constellation Brands, ticker symbol STZ. As we can see, not far off the 52-week low, with a double buy rating from Seeking Alpha and Wall Street. We get a hold from Quant, and right now, in terms of a forward PE, it is at the 1.69 percentage point. Now, over the last 12 months, we can see the performance is flat, and from the last 10 years, we do note if you were an investor, you would have outperformed the S&P 500. Now, in terms of their earnings, very positive to note, over the next 4 quarters, they are anticipating strong year-on-year EPS growth, and we can also see from the previous 4 quarters, they have a 100% track record of outperforming management targets. We can also see they expect the growth to continue with February 2026 EPS of 15.19, lowering down that forward PE to around 15.78. Now for each one, we'll have a quick snapshot of some of their metrics. Dividend safety, it has a score of 70. As we can see, the yield does sit above the 5-year line, indicating undervaluation. We also see that based on the forward PE, there is another undervaluation signal, and very impressive to note that their more recent dividend increase in April this year did come at that double-digit rate that we love to see at 13%. Now, as always, important to understand where it sits in terms of the valuation, and in today's episode, the intrinsic value comes around $273. As always, we do deep dives on this channel. We run through the inputs and the outputs. In today's episode, we're going through 10, so let's be a little bit quicker. We see $273, current price around $241, and as always, we do like to do a margin of safety as we go along today. 10% is the starting point. We execute on this if we believe the company hits our 3 criteria: wide moat, strong financial metrics, and good forward-looking data. And if you believe that for Constellation Brands, it is a buy up to $246. It doesn't quite hit the 15% level yet. You'd need to wait around $232. At the 20% level, $218, and at 25%, $205. So in today's episode, at least a 10% MOS up to $206. And as we saw, Wall Street did give it a buy rating. They have a price target just under $300, and they see over the next 12 months upside of 24%. As always, do give us your thoughts about each of these 10 stocks as we go through them today. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop these to your inbox every single Monday morning, where we talk about what's happened over the last few days in the market, as well as undervalued dividend stocks that we do believe deserve your attention. So do click below, sign up, and you can read straight away, where you will also be able to gain access to 36 undervalued dividend stocks for the month of October. We've got a lot of information to cover for each one. We also talk about those that sit within our own portfolio. And on top of that, if you do like spreadsheets, you can grab another one which runs through 22 undervalued dividend stocks with the most upside according to Wall Street. So as we said, click below, sign up, and read straight away. We then move on to the next company. It is a dividend king, 50 plus years of increases. It is GPC, Genuine Parts Company. You have a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, as we can see trading towards its 52-week lows, a forward yield bang on 3%, a forward PE just above 14, significantly lower than the S&P 500. Over the last 12 months, down 8%, not that great. Over the last 10 years, up around 54%. Again, not the greatest. You would have underperformed the S&P if you had bought 10 years ago. But as we can see, if you did buy around the COVID drop, you would be up more than double. All-time highs as well for this company. November 2022, nearly 2 years ago, at $188. Now, in terms of their earnings, moving forwards, they are anticipating 3 of the next 4 quarters to be growth. The next quarter, in fact, a small decrease of 2% year on year, and they have a 75% track record. Important to note, they did have a fairly large miss in the latest quarter of 15 cents. Nonetheless, the next full year earnings per share is expected to continue to climb, lowering that forward PE to 13.09. Now, in terms of dividend safety for this Dividend King, they have an 80 score safe. Again, we do get that undervaluation signal with the yield above the 5-year average. We get a reasonable valuation on the forward P, although it is towards the lower end, with an above inflation increase to the dividend at 5.3% this year. Remember, on this channel, we do target at a bare minimum 4% just to keep up in line with inflation. Now, in terms of our valuation today, $159, and when we do put it through the MOS at 10%, a buy at 143, and we actually see in today's episode, if you are adding this Dividend King to your portfolio, you're getting around a 15% margin of safety, with Wall Street giving it 12% upside, 152 price target over the next year. Continuing on, we have Dollar General, ticker symbol DG, with a buy from Wall Street, a hold from Seeking Alpha, and a sell from Quant. This one is pretty much trading right there at its 52-week low, with a forward yield of 2.86%, a forward P just above 14, and over the last 12 months, this has been hammered down 22%. Over the last 10 years, not great, only up 37%, as we can in fact see downward trending since October 22, 2 years ago, with a price of $261. Now, when we look moving forwards, only 2 of the next 4 quarters they're anticipating growth. In fact, important to understand the next 2 quarters, they're highlighting double-digit decreases to the EPS, and they also missed their more recent earnings, although we can see 75% track record. Nonetheless, moving forwards, an increase to the earnings per share, bringing that forward P down to 12.83. Now, this is our first borderline safe dividend score, which means there could be an expected dividend cut over the next full economic cycle. We have a massive undervaluation signal. Yield is above that 5-year average line. We also get an undervaluation on the forward PE, and we can see we are still waiting for a dividend increase from Dollar General this year. In terms of the valuation, with our intrinsic value of $98, we can see it is a little bit lower than Wall Street. Their price target $103, they see 26% upside. And when we do look at it through the MOS perspective, 10% a buy at $88, at 50% around 83, not quite at 20% just yet, sitting somewhere between 15 to 20%. As we can see though, Wall Street very bullish, 26% upside expected. We then move on to Merck Co with a buy rating from Wall Street. 4.48 isn't too far off a strong buy signal that would be at 4.5. A hold, however, from both Seeking Alpha and Quant, trading towards its 52-week low. Forward yield of 2.82%, forward P just below 14 at 13.6. Over the last 12 months, not great, just up 5%. Over the last 10 years, we can see it is okay, up 101, but still you would have underperformed the S&P 500. In terms of their earnings, well, moving forward, 3 of the next 4 quarters, they expect growth. We do anticipate the next quarter to be double-digit decrease. Nice to report, though, the last 4 quarters, they have a 100% track record, with some strong growth anticipated over the next full year, December 2025. Forward P 11.26. Dividend safety, very impressive, 90 score, giving it a very safe indication, meaning a dividend cut is highly unlikely. And in fact, we do get pretty much a reasonable valuation signal, both on the yield as well as that forward P, with an above or marginally above inflation increase in November last year, signaling we are anticipating an increase to the dividend over the next few weeks. In terms of the valuation, well, $146, which does emphasize quite a large MOS level in today's episode. At 20%, a buy at 117. At 30%, not quite there yet. So in today's episode, you are getting at least a 25% MOS based on the current price of $109. With Wall Street still very bullish, upside 28%, near a strong buy signal at the $140 mark. We then move into the semiconductor space, where we have a double buy rating with a sell from Quant. STM trading right now at its 52-week low. A forward yield on the lower side today at 1.2%, a forward P at 16.7, and over the last 12 months they have been hammered negative 38%. Over the last 10 years though, this one has significantly outperformed the S&P, up 316%. Now with this space, bear in mind it is very cyclical, and that is shown pretty much through the expectations. They do anticipate a decrease for the next 3 of the 4 quarters to the EPS, and we do notice a beat in the more recent quarter, however a 75% track record, as they did miss Q1 24 earnings. Nonetheless, moving forward, some big growth anticipated. That forward P is expected to come all the way down to 12.45. We don't currently have a dividend score from them, but what we do notice here is that they did increase their dividend at a very rapid rate of 50% just over the last full year. In terms of our intrinsic value, $41, not too far off Wall Street at 42, where they see massive upside of 50% just over the next year. And when we take a look at it from an MOS perspective, we can see in today's episode, you are getting a 25% MOS at $31, at the 30% pretty much right at the current price. So 30% MOS, 50% upside, and as always, do give us your thoughts below. If you are interested, we can do a deeper dive on some of these stocks we are taking a very high level look at today. We then move on to ADM, Archer-Daniels-Midland company, with just one buy rating from Seeking Alpha, a double hold from Wall Street and Quant, trading towards its 52-week lows, a yield on the higher side today at 3.5%, one of the lower forward Ps at 10.8, and over the last year it is down 22%. Over the last 10 years as well, not the greatest, up around 31%, with all-time highs around 2 years ago at just under that $100 mark. In terms of their earnings, well, actually the next 2 or 4 quarters they expect decreases to the EPS, and they've also missed 2 of the last 4, giving them that 50% track record, with only a marginal increase to the EPS anticipated from December 2024, lowering down that forward PE very marginally to 10.64. Now their dividend does look to be safe, which is always a good sign, and we have both an undervaluation signal on the yield and the forward PE, with a very nice and impressive double-digit increase to their dividend of 11% in January this year. Now, in terms of this price, we do notice that our intrinsic value of $64 isn't dissimilar from Wall Street 63, where they see upside of 10%. And when we do look at it through the MOS perspective, we pretty much see a 10% margin of safety. Now, that may not be enough for a lot of people, so at the 50% point, you would have to wait for around $55, at 20% around $51, and at 25% around $48. But as we said in today's episode, 10% margin of safety, 10% upside, and don't forget you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for ADM or any others that you do desire. Moving on, we have CNI, the railroad company, Canadian National Railway, with just a buy rating from Seeking Alpha, a double hold from the other analysts, trading in the mid to lower end of the 52-week range, a forward yield of 2.15%, one of the higher forward Ps today at 21.2. Over the last 12 months, marginal increase of 6%. Over the last 10 years, up around 78%, underperforming the S&P. We do notice though growth baked into the next 4 quarters, ranging from low single digit to double digits in quarter 2 2025, and as we can see, they have missed 2 of the last 4 quarters. Nonetheless, growth still anticipated over the next full year, lowering that forward P to just below 19. We get another very safe dividend score at 97, with an undervaluation signal both on the yield as well as the forward PE, with a mid to high single digit increase of 7% to their dividend in January this year. In terms of the valuation, well, intrinsic value of $133 does give a 10% MOS up to $120. At 15%, you would have to wait for $113, so sitting somewhere between 10 to 15%, with Wall Street giving this 9% upside, $127 price target, and as we saw, they did give this a hold rating. We then move on to Jack in the Box with a double buy rating, although we do notice Quant has given this a sell, trading at its 52-week low with a yield of just under 4%, a forward P just over 7. Over the last year, not great at all, down 32%. Could this be a market overreaction? Could this be opportunity? Over the last 10 years though, we do notice it is down 33%, pretty much had its highs around 3 years ago at $120. However, having said that, they do anticipate, although not the largest growth to the EPS over the next 4 quarters, with a 50% track record. Positive to note is the last 2 have been beats, with a marginal increase expected over the next full year, bringing the forward P down to 6.7. Now, we don't currently have a dividend safety score, and we are still waiting for their latest growth for the next full year. But one thing we do notice with this company is that there is some nice upside according to Wall Street. $62 price target, 38% expected over the next year. And we also know our intrinsic value is fairly high, meaning in today's episode, there is quite a substantial margin of safety. At the 35% point, a buy up to $50. at 40%, pretty much where this company is trading at now. And as we said, if you do want a deeper dive of some of these companies, do let us know. Or in fact, if you have been accumulating some of them, also give us your thoughts below. We then move on to Evolution with a buy rating from Seeking Alpha. This one is trading towards its 52-week lows with a forward yield of 3.07%, a P of around 17. Over the last 12 months, well, down 11.5%. Over the last 5 years, outperformed the S&P, up 336%. Now, we do have the previous 2 quarters where there was a marginal miss of 3 cents in quarter 4, and in the previous quarter, a marginal beat of 3 cents. Now, jumping into the valuation of this company at $131, similar to Jack in the Box, we do have a substantial MOS level. And in today's episode, we can see at the 30% point, it isn't too far off. $92 is where we would see this, and Wall Street giving them 34% upside, a price target of $126. Definitely one to consider in the portfolio. We then move on to LVMH with a buy rating from Seeking Alpha. This one also trading right there towards its 52-week lows, a lower forward yield of 1.7%, a forward P of around 24, and over the last year we can see not great, down 4%. Over the last 10 years though, massive outperformance of the S&P, up 347%, with their all-time highs being around the $1,000 mark around a year ago. Now, we don't have their earnings expectations, but we can see that over the next full year, they are anticipating that top-line revenue to increase by around 5%. Now, in terms of the valuation, our intrinsic value of $914 does give some nice MOS for this luxury brands company. 10% a buy at 822, at 20% around 731. Not at the 25% level just yet, so sitting somewhere between 20 to 25%, with Wall Street, who have recently lowered their forecasted price to $825, still seeing upside of around 15% over the next full year. As always, give us your thoughts in the comments below, whether you're looking to buy any of these 10, maybe you're looking to hold, or for whatever reason they aren't companies you're looking to consider. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you're continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, as well as coming and joining us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.